Hello, everyone. Today on the Final Bar, I'm talking with Clif Droke. We'll get his take on this current market environment, a choppy week, and today returning right back to the distribution phase. We took a brief couple-hour break from yesterday afternoon around the Fed meeting. The end of the day, still a lot of weight in the market with the Nasdaq down over 4%, energy down over 5%. We're going to look at the energy sector because that's where we've seen some fairly significant pullbacks in an area of the market that has obviously been strength so far this year. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of stock charts, using data visualization techniques to better understand what is happening around us as investors. It's all about investor psychology and the tools of the technical toolkit, I would argue, that help you quantify investor psychology and show how price represents their collective mood, their collective fear, anxiety, and potential opportunities. Yesterday's show, we were talking about the bounce going into the close, and I would say it was a cautionary tale on, let's not get too excited about this short-term rally. At the end of the day, the world has not really changed a lot in a couple hours. The headwinds that have caused the S&P and the Nasdaq to struggle so much year to date, certainly very much still there yesterday afternoon. Bit of short-term optimism after the Fed meeting. Today, right back with that downtrend continuing on, with the S&P finishing down about 3.25%, the Dow down as well. We're going to get into all the details and look at a bunch of charts here in a few moments. Did want to take a minute and let you know what's coming up on our show. We've got Clif Droke a little later today. I'm excited to get his take on what all we're seeing in the markets. Next couple of days, we're taking a time off from live shows. I'm taking a little vacation with the family up to Eastern Washington. We've got some really cool special content for you. Tomorrow, we're going to talk all about best practices for analyzing markets using trend lines. On Monday, we'll talk about the benefits of learning from market history. That's a really important show given how pivotal a lot of these events are that we're seeing in 2022. You can learn a lot from looking at previous market cycles to help give yourself an edge. And then on Tuesday, we'll talk about comparing multiple stocks using our stock charts platform. One guest to let you know about next week on the 23rd, we have Mary Ellen McGonigal, a well-known face and name on Stock Charts TV. Also to let you know, we'll be doing an event for the Money Show coming up next week on Thursday, June 23rd at 12 p.m. Eastern, called The Most Important Chart of the Day. I've started every trading day for years looking at the same chart. I will show you what that chart is, why it is so important to look at every day, and why it's so important to look at right at the beginning. Go to stockcharts.com/money show to sign up for that event and to get more information about the details of the discussion. Let's continue on today's show with our market recap. Let's talk about what's happening and try to improve or upgrade our market awareness, understand where the trends are evolving. In terms of trend evolution, for the most part, it's down. I was actually scanning for new highs and new lows earlier today. Do you know how many new highs I had in my large cap and mid cap US universe? 2 out of thousands of stocks, a grand total of 2, actually getting a new 3-month high today, over 500 making a new swing low. I'm not super surprised given the broad decline that we've seen, the fact that it's single digits. I think as of the close today, it's probably 5% of the S&P still above their 50-day moving average. That's pretty low. And pretty much its energy are the only names that are really still holding up above there. The Nasdaq leading the way downwards, down a little more earlier in the day, settled in to close down about 4%. That's around 10,650 on the Nasdaq Composite. Mid caps and small caps both underperforming the S&P. With the small cap index, the S&P 600 down almost 5% today. The VIX is pushing back higher. There's been a lot of choppiness in the VIX. We have a segment later today called Getting Sentimental, where we're digging into some of the sentiment indicators. The VIX is above 30 again, 33 again. Interest rates coming off a bit. This after yesterday, you had the bounce in rates, and this morning also pushing a bit higher. 10-year yields coming off a bit, but still at 3.3%. So we're still pretty high relative to where we've been over the last 6 to 12 months. Long bond yields obviously over 3.3% as well. Dollar coming off a bit by about 1% using the UUP dollar bullish ETF. In the commodity space, commodities a bit mixed, but overall net positive with gold prices up 1.1% using the GLD, silver up 1.4%, oil prices higher. But boy, the worst sector by far was the energy sector today. Now, again, coming off of a run of continuing to be the top performing sector year to date. So let's keep things into proper context, but certainly feeling the pain today. A lot of red on in crypto land yesterday. We talked about Bitcoin getting back up to the low 20,000s, bouncing up from a low level after sort of skimming the surface of the 20,000 level yesterday in the overnight session 2 days ago. Bitcoin today down 7%, just below 21,000. Ether just above 1,100. That's down 10.5% from yesterday. So if you're looking for a sign of the end of the bear market phase in cryptocurrencies, I would not say I'm seeing that sort of evidence today. Earlier today, by the way, we recorded our latest episode of The Pitch. One of the guest commentators, Dave Landry, one of his 5 picks was essentially a short Bitcoin discussion. It was more of a, best to avoid this type of chart type of thing, but it was not an optimistic look at cryptocurrencies overall. Let's look at a daily chart of the S&P. Now, the chart has evolved quite a bit in the last week and a half, right? A week and a half ago, not last week, but the week before, we're talking about this bounce off of 3,800, really 3,810 or so, retracing a bit, sort of this nice potential bounce. And back here, you're seeing stocks like some of the FANG names bouncing pretty nicely off of the lows. You could make the argument if we made a new swing high, is this the beginning of a broader recovery? What would we need to see to get more optimistic? I tell you what we did not need to see was what we actually experienced, which was a couple gaps lower, a couple big down days, all of a sudden completely changed the character right back to that bear market phase we'd gotten so comfortable with. We talked about how the rally into resistance was important, the consolidation phase, and waiting to see which way that the consolidation breaks. Do we make a new swing high or a new swing low? Clearly, the path was lower, and from there, we've really not looked back. Yesterday's bounce was a brief couple-hour break from the overall downtrend. Most days over the last week and a half have been down days, and what I mean is closing lower than yesterday and closing more toward the lows of the day. That is very much a market in a distribution phase, and it tells you there's an evaporation of buyers. Right? There's no one really coming in yet and buying into weakness. So there's additional movements more to risk-averse areas of the market. The number one sector today, consumer staples, is a fairly defensive sector, and that's what we're seeing. So if you take a step back, you can see how 2021 was a pattern of higher highs and higher lows. 2022 has been a pattern of lower lows and lower highs. This week is just getting yet another new low for the year and continuing that pattern. And what I would suggest is you have a clear pattern of lower highs. If we would rally, get a bear market rally in this environment, all you need to do is look to the left and see what we would need to achieve to make a new swing high. And if that happens, you can start to, I think, develop a bit of optimism and start to look for opportunities in individual stocks. Until then, though, it's telling you the tide is going out, the trend is down, and overall, this is a market to remain most likely sort of on the risk off side. In terms of sector movements, it was very much a defense over offense feel to the day. And again, after yesterday's bounce going into the close, today was, and that's actually not true. If you look at what actually happened yesterday, there was a rally up until about 3:30, but the last half hour was distribution. Now, that was a telling warning about what may come today. And you saw the action in futures overnight, where it rotated to a fairly negative open. That's sort of how things played out, and really the course of the day was lower. Consumer staples, the best performing sector, still down about 0.7%. But the best performer, followed by healthcare, utilities, and then real estate. On the downside, energy, which has been the strongest sector year to date by far. Then the growthy leadership, the FANG sectors of consumer discretionary, technology, and communication services. I did a presentation yesterday for the Boston Investors Group. We were talking about a number of different sort of charting tools to help make sense of things in a bear market phase. What kind of signs you should be looking for. One of the things we talked about was traditional leadership out of the lows tends to come from technology and consumer discretionary, right? And when you look back historically at the average bear market and what the recovery starts to look like, those are the sectors that tend to do pretty well. As a matter of fact, if you go to the sector performance chart, which on StockCharts, go to charts and tools, and then on the right column, go down to this sector perf chart. This shows you the returns in the major sectors. And just briefly, if we look year to date, energy is still up 70%. It's as of yesterday's close. It's not updated for today's close just yet, but still by far the top performing sector. You can see it's not even close when you compare it to others. But the other top performing sectors after energy, big gap lower to the next couple, but it's utilities and it's staples and it's healthcare. These are all fairly defensive sectors. These are where you hide out when market conditions are uncertain. And the stuff that would lead most likely out of a low are all showing the weakest performance year to date. This is the illustration I wanted to get to. This is Sam Stovall's sort of idealized market cycle. So number one, remember that the market tends to lead the economy. So if you're looking at economic data, trying to get an edge on the stock market, you're actually doing it in the wrong order. What you should be doing is looking at the stock market for a sense of what the economy is most likely going to be doing, because the stock market is one of the best leading indicators of economic conditions. You can see when the market bottoms and starts to turn higher, the sectors that tend to work: technology, consumer discretionary. Higher rate environment, a rising rate environment, which we are in, does not tend to be a great environment for those sectors, which is why I would think the recovery is certainly not here yet. We're seeing further signs of distribution. Let's take a quick commercial break. We'll be back with today's guest, Clif Droke. We'll see you in a minute.
What if you could look beyond price and identify big moves in the market before they happen? That's why we created the Moxie Indicator Minutes. Hosted by me, T.G. Watkins of Simpler Trading, the creator of the Moxie Indicator. Each week, I'll provide you details about the indicator, what it does, and how it can work for you. Only on StockCharts TV.
Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you joining us every weekday after the close for our show. A couple quick announcements before I bring on our guest today, Clif Droke. First off, we welcome your questions. We have a mailbag segment, which we'll be running pretty regularly. We have to take a bit of a break. We'll do one next week for sure. You can get your questions to us via email, thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air on next week's mailbag. Also, go to stockchartstv.com. That is our on-demand platform. So much great content, excellent market experts like Clif Droke, Dave Landry, Joe Rabel, many, many others. Also, all of our special events like Larry Williams' Market Outlook, our latest episode of The Pitch, which we are just broadcasting today. So much more for free at stockchartstv.com, or on your mobile device, just search for StockCharts TV on demand. I want to welcome on today's guest, Clif Droke. Clif is joining us back on the show. Clif's the editor of SX Gold and Metals Advisory. Clif, it's great to see you again. Welcome back to the show.
Likewise. Thank you, Dave, for having me on. It's always good to be here.
So I don't know if there are easy weeks to come on a program as a guest and sort of give your take, but this might be one of the more challenging ones with a lot of volatility, a lot of uncertainty. You're starting us off looking at new lows on the Nasdaq. What are you seeing here? What is it telling you about the broader market environment?
Well, you alluded to this earlier in the webcast, Dave, but what this tells me is this is my number one indicator. This to me, new lows are one of the single most important indicators an investor can look at. And the magic number here is 40. Whenever you get new lows well above 40 on a daily basis, it means the underlying environment is bearish. The problem we've had in this market is we've had close to triple-digit new lows for the better part of the last 9 months or more, and that just screams distribution. It started last year with the healthcare sector, the biopharma stocks in particular. It's now spilled over into income-oriented stocks, bond funds, et cetera. And as long as we're seeing these triple-digit new lows, we are definitely stuck in a bear market. So we need to see the lows shrink below 40 for a few days consecutively to let us give us that first heads up that things are changing for the better.
Right. For the market to stop going down, we need stocks, individual names to stop going down. And that certainly doesn't seem to be the case using your chart, which is beautifully illustrated. Now, talk to us about volatility. We're going to do a segment later today about sentiment. What is your sense of the VIX here, and what does it mean?
Well, to me, I mentioned for new lows, the magic number is 40. For the VIX, my magic number is 25. Historically, I find when the VIX is above 25, it is not a good environment to be buying stocks. I want to see the VIX not only go below 25 and close at least 1 week below it, but begin to trend below 25. That has not been the case for the better part of this year. So whenever the last bottoming attempt, I believe a few days ago, the VIX came very close to getting below 25, didn't quite make it. So I would say to investors, keep an eye on 25. As long as we're above 25, it's dangerous to be a buyer.
Yeah, it's tough when these broad indicators like new lows, like volatility, certainly just continuing to point to further downside potential. Now, one area of the market, Cliff, which I'd love to ask you about is commodities, particularly gold. You know, a lot of people, I think, simplistically, maybe for better or worse, think stocks are struggling. Where do you go, right? Where's the safe haven? And gold has often been one of those things that people think about. We're looking at the gold contract here. What's your sense of the trajectory in gold, and what's the prospects for gold through the remainder of the year, in your opinion?
I think the prospects are quite nice that we will see some upside in gold. It's been a tough time for gold investors this year because the currency component, because of the dollar strength. There's a little trick I'll share with your viewers. If you go to StockCharts and you can see the symbol $ gold, if you type in after that the colon and then the symbol for the S&P 500 $SPX, you will get a relative performance chart which will show the relative strength. And as you can see, it's in the process of trying to make higher highs, higher lows. That is one of the very few strong relative performance chart among major assets right now. It's a good sign. So
it's such a great way to. I'm so glad you asked me to do that, because it's so funny, you get caught up into just the analysis of the particular chart. The chart of gold has been fairly choppy, but choppy is a pretty decent performance in this environment, right? We'll take choppy as opposed to straight down, I guess, right?
Absolutely, it's holding its own versus most stocks and other commodity or other assets right now. So it's got some potential. And I'll say one more thing about gold. Typically, when you get a big downside move in the stock market like we're seeing, once the stock market bottoms out, gold usually takes off because people are spooked and they're looking for a safe haven, and usually outperforms.
Just to finish off, we only have about a minute left, Cliff. But when you're looking at the S&P 500, obviously we've bounced off of support a number of times, and just there doesn't seem to be a floor. You talk about things like new lows and broader indicators. Is there a particular level that you think is important to watch on the S&P, or something on the chart of the S&P that you would look at on its own to help you anticipate or identify a potential market bottom here?
As far as a level, no. I've learned that in a bear market, especially a panic environment, support means very little. Support levels. I would look at the 15-day moving average. A 2-day higher close above that, and the S&P would be a good sign to me. A start. It would be a good start.
Yeah, I feel like at this point, right, you need the start before you can start to materialize any gains. We got to have that beginning. We really haven't been able to see any sort of beginning start just yet. Cliff, listen, it's great to see you. Really appreciate you sharing some charts with us today. Stay safe there. Be well. We'll talk to you again soon.
Thank you, David. Appreciate it.
That's Clif Droke joining us today. Cliff's the editor of SX Gold and Metals Advisory. He had a number of just great charts there. And I love that Nasdaq new lows. And what I love about the final bar, bringing people like Cliff in and getting to chat with him about what he's seeing. But that's an indicator I don't pay a ton of attention to. And when someone like Cliff says, this is the most important thing I'm watching, our new lows on the Nasdaq, don't look now, but Cliff, that is now on my list of indicators to pay attention to. Great take there from my guest, Clif Droke. Let's continue on today's show. Moving on to our next segment, Getting Sentimental. We like to do once a week or so is focus on some of the sentiment indicators that really help you understand how different investors are positioned and also what they're thinking, because some of the stuff I would bucket as sentiment indicators are things like survey data and other things, right? What are you bullish or bearish on a particular market? A lot of times that can be really helpful to understand the broader perspective that what investors are thinking as they are making these buy and sell decisions. Now we'll start with the VIX. I don't want to spend a ton of time with this one because I thought my guest today, Clif Droke, did a great job of talking through the VIX. I've highlighted sort of this volatility regime that I think we're in. 2022 has essentially ranged between 15 to 20 on the lower end, 30, 35 on the upper end. I highlighted 40 because that's really where we hit resistance after the March 2020 sell-off, February to March. You had a spike in the VIX up into the 80s. We then settled back into a new range, and 40 ended up being the peak for quite some time. I'm very interested to see if we are able to get up to that level. I've talked to a number of people that would say if we get above 40, that's a pretty extreme level for the VIX. That's where you'd maybe start wanting to look for some sort of market bottoming pattern. It's worth noting we're nearing 35, which is where the drop in May and the drop in March actually bottomed out. We're actually already past the level that we were at the January low. So we'll see if where the VIX goes from here, but certainly elevated and at the upper end of the range we've experienced so far in 2022. Looking at some survey data, sort of a change in the AAII survey 2 weeks ago, we had an almost even number of bulls to bears. Bears still outnumbering bulls by just about 5%, but much more to an even keel. And that was after that bounce off of the lows just above 3,800. Now the world has changed here in the last couple of weeks. After this bounce, we're now accelerating to the downside. Still 20%, really 19% of respondents were bullish, which tells you there is still some optimism out here. And again, it never really gets down to single digits. There are some, let's call them perma bulls, who are always optimistic about stocks. And, don't get me wrong, over the long term, you probably have been on the right side more than you haven't been. And that's what you have to remember. When you're too bearish on stocks, you have to remember that on average, most of the time that the equity market exists, it has been bullish versus bearish, right? The bear markets are much less common because the market is overall appreciated in value by a great deal over time. However, there are times when it certainly pays to be bearish or where it does not pay to be bullish. This might be one of those. Bearish sentiment, by the way, almost to a new high for the year. About 58% respondents saying that they are bearish on stocks for the next 6 months. Combine the two of those, it's a spread of about 39% bears over bulls. We were a little heavier than that to the bear side in April, but this remains one of the lowest levels that we've seen. Now, before you get too excited thinking that's an obvious contrarian buy signal, in extended bear market phases, that number can remain pretty high in terms of the bearishness, and there can be a lot less bulls, and that can persist for quite some time. Where I'm also seeing some interesting movements is with the name exposure index. Last week, we saw a bit of a jump here as money managers in their poll were right about to 50%. And that's basically how exposed are you to the equity market? What's your equity exposure right now? Now, 50%, which is where we're at last week, is still relatively low. If you look at the average allocation, it's about 70%, 60, 70%. You think about the 60-40 split, that makes sense, right? That on average, money managers say they're about 70% in equities because the other parts are other asset classes. We were still pretty low at 50%. That was the highest level we'd seen in 4 weeks, but still below average. This week, we're right back down to fairly defensive positioning, just above 30%. Pretty rare when we get that low. If you look back in the history of the name exposure index, we've only gotten below 30% in pretty significant bear market phases. The last time we were this low, besides 2022, was in the first quarter of 2020 when the market started to sell off. You also were in those levels 2015, 16, briefly at the end of 2018, and also obviously in 2008 and 2009. RIDEX flows still relatively defensive relative to where we were at the beginning of the year. So we've seen a steady decline as investors in the RIDEX funds have rotated from the very bullish configured funds, things like offensive funds, long funds, sector funds, for example, and moving more to the relative defensive income-oriented funds, cash, money market types of funds in the RIDEX family. So while the value has increased, basically meaning that they're more on the defensive side of the ledger, we're not to the level of bearish positioning that we saw in 2020 or in 2018 or even in 2015 and 16. Look at how high that value got or how low it got visually on the chart. This is plotted inversely to be more in line with most of the sentiment indicators that we track. So these bars getting higher and higher, further away from the zero line, basically shows you that investors are more and more defensively positioned. According to that survey, investors are most bearishly positioned at market bottoms. That's why it's thought of as a contrarian indicator. So super bullish positioning at the end of last year makes sense. The market has come off. Now we're more defensive relative to where we've been over the last year or two, but not to the negative positioning that we've seen at previous bear market bottoms. That's what concerns me about that particular indicator. We're bearish, but not climactically negatively bearish. It's just kind of sort of bearish. And that unfortunately leaves the door open to further downside in that sort of chart. Finally, just briefly, the put call ratios. Now, the put call ratio is a daily reading from the CBOE. It looks at the options market for index and equity options, or when we have that's just equity only. We'll look at both of them briefly. I like to smooth this out with a 5-day moving average, which is the level you see in pink, and have a horizontal line showing you where we're at relative to where we've been. As you see, with the spike that we've seen most recently in the put call ratio, we're getting up into the range that we were in February, March of 2020. Now, the put call ratio spiked a lot higher in March of 2020, which again is one of those things when I'm thinking about this current decline and how that compares to previous declines, I see that there's more room on this chart for investors to get more bearishly positioned. It hasn't quite happened yet. No real difference, I would say, in the equity only version of that ratio. Put call ratio is the highest it's been so far in 2022 in terms of the average reading, but again, not near the extremes that we've seen in previous bear market cycles. That tells me there's more room to be had on the downside for stocks and on the upside for indicators like the put call ratio. That is our segment, Getting Sentimental. Again, some bearish indications. The survey data in particular telling you an influx of bearish sentiment, but still potential for further downside for stocks. We need to wrap the show, folks. Go to the 3 and 3. Let's talk about 3 charts that tell the story of this market in about 3 minutes. And here's chart number 1. Offense versus defense is one of my favorite things. Again, I was recording our latest episode of The Pitch, and my third contributor was Jessica Inskip from Options Play. We had a lot of fun, the 4 of us, talking about the market environment, just the challenges of picking stocks and ETFs during this sort of week when things are just being completely unhinged, it feels like, in a lot of ways, and accelerating to the downside. One of the stocks that Jessica threw in there was Starbucks, and we were laughing about how Starbucks is technically in the consumer discretionary sector. It's thought of as a discretionary good. I often talk about consumer discretionary as things you want, consumer staples as things you need. And by that definition, Starbucks may be better labeled as a consumer staples. I know a lot of people that can't do without that and probably would buy their Starbucks in any environment. But the idea of this ratio is to look at offense versus defense. Are consumers spending more on things they want or more on spending on things they need? And it's making that inference by looking at the relative performance of consumer discretionary versus consumer staples. At the top is the cap-weighted version of that ratio. The bottom, the equal-weighted version of that ratio. The equal-weighted offense to defensive ratio, very close to making a new low for the year. Not quite doing it, but very, very close. The cap-weighted version a little bit above there. Even though it's been bouncing around recently, just look at the clear downtrend and the reversal from uptrend in 2021 to downtrend in 2022. That tells me the bear market is healthy and very much alive. Chart number 2 is looking at new highs and new lows. I loved Clif Droke's chart on Nasdaq new lows, which I made a note. I'll try to start to incorporate that a little bit better. I think that was a great illustration. Here we're looking at new lows in the New York Stock Exchange, common stock only. Here we're looking at new lows for the S&P 500. 40% of the S&P making a new 52-week low today? That's a big number, right? And that tells you that there's distribution. A downtrend has a lot of new lows. The bottom is where you see an evaporation in new lows. We've not seen that yet. Finally, my chart of the VIX. Again, when we talk about volatility, I tend to think of it in volatility regimes. After the 2020 sell-off, you had one sort of elevated volatility period at the second half of 2020, a relatively low volatility period in mid-2021, and now we're sort of going back into a bit of an uptrend. Look at the trend in the last 6 to 8 months, clearly higher for the VIX, which models or sort of mirrors the downtrend that we've seen in stocks. However, it's been an overall, elevated pattern with 20 on the lower end, 30, 35 on the upper end. So while we're in the upper end of observations for the VIX, and that tells me to start to look for signs of a potential tradable bottom, it also tells me that there's much higher that the VIX can go. When things really get bombed out, volatility can spike a lot higher. Let's keep this chart available and see how things play out. Folks, that's a wrap for this show. I want a special thank you to Clif Droke joining us today, sharing his great thoughts on breadth and the material sector. All of our previous interviews and a lot of special content is for free at StockChartsTV.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.